Welcome. In this video we'll be going over the HARP 2 refinance program, and this is a refinancing program for underwater homeowners. Under the HARP 2 program, it does not matter how underwater you are. The previous HARP program, the original one, it was only limited to people who are up to 25% underwater. Now it does not matter how underwater you are. You may still qualify for refinancing. However, the loan must be owned by Fannie Mae or Freddie Mac, which are both government-sponsored entities in which they buy loans from the banks and then hold them until the loan gets paid off. And also, the loan must have been put in place before June 1st, 2009. Now, bear in mind that if you're still making your loan payments to the original bank, that does not mean that that bank owns the loan. The loan could actually be owned by Fannie Mae, Freddie Mac, or another third-party investor. Many times these third parties, they do not have a program that will collect the payments and service the loan and so on. So although your original bank is still doing that work, the loan could be owned by one of these two companies. So the first thing we need to do is check to see whether Fannie or Freddie owns these loans. You can do that on the links displayed at the bottom of this slide, and we will go through one of those right now. Okay, now I'm at the Freddie Mac website. That's the one that I will use as the example. And on the previous slide I had the link listed. However, make sure you have the S and HTTPS, otherwise the link will not work. So I had HTTP. Make sure you add the S to the URL up here before you try to use the lookup service. Now what I will do is I will add all the fields. I will look up one of my loans, and it's going to ask you for your first name, last name, house number, and street name. You don't have to put any details, just the name of the street. So if it's Main Street, you just put Main. And then they also require that you have the last 4 digits of your social security number. There's no getting around this. It is just a required field that they have. So I will go ahead and do that and show you that if you do have a Freddie Mac loan, what it will look like on the next screen. Okay, I have filled out that form and submitted it, and it says yes, our records show that Freddie Mac is the owner of your mortgage. And now the important point of this example is that I actually make my payments to Chase Bank, which was the original loan company that I borrowed the money from to buy this property. So it is important that you look both of these up to see that you would be eligible for refinancing. Now, this loan I would be eligible. So if you are not, if it does not say this and you've looked at the Freddie Mac website, then go ahead and try the Fannie Mae website. It should be a very similar process, and excuse me, and then see if your loan is owned by them to see if you qualify for this program. Now, in the next slide, what we will do is we will look at an example of how much money you could potentially save on a mortgage. Okay, now we are on this loan comparison slide, and we are assuming that we have an old loan balance. The loan that we currently have has a $300,000 balance, a 6% interest rate, and that equates to a payment of $1,799. That's just the loan itself. That doesn't include the taxes and insurance. So we have a very simplified example here. Now let's say we can qualify for a new loan in which we can get our interest rate dropped 2% from 6% to 4%, and that would save us $367 a month because our payment went from $1,799 to $1,432 per month. And let's say to go with the refinance, we have to pay total closing costs of $7,100. Now, depending on your situation, you could either pay this out of pocket or you can have this added into the balance of the loan. And this particular example, if we take our monthly savings, divide that by the closing costs, we get a number of 19.3, which is the number of months that it would take to recover that $7,100, which is the cost of the refinance. And that's a little over a year and a half, so that is actually a pretty good deal. Now, it's ultimately going to depend on how much you want to stay in that home, how long you plan on keeping that home, as to whether or not this example would be worth it. Now, keep in mind there's a lot of fixed costs involved within the closing costs. So if you have a loan balance that is small, say $100,000 for example, then it would take many more months to recover the closing costs in which you would save. So the higher the loan balance, the faster that you would recover all the costs of refinancing. Now, these numbers are just approximate. As it says below, your credit score, income, and your specific situation will depend on how much you will save by refinancing. And it just ultimately depends on, as we said, how long you want to stay in that home, whether or not you want to keep the home. As we can see in the example, you may not get any balance reduction. It may just save you on the interest rate. But just saving a couple percent can save like $367 a month or more depending on your balance, and that will make a difference, and it will make your home that much more affordable.